And on to the next panel.
Before we proceed, there are barcodes on the badges for you to scan and check out the agenda. So if you can just scan it with your phone, you can check out the agenda for the entire day. Okay. So the topic for the second panel is why dual listing. And please allow me to introduce the moderator, Ms. Zahara Malik, the CEO and co-founder of Grosvenor Capital, to take the stance. Thank you all.
Thank you so much. You weren't allowing me to give you a proper introduction.
Oh, sorry. Do you want me to go back and sit down again?
Yeah, no. Completely. You're officially my second favourite Attenborough.
Not alone in that.
I know, I had to do it. I'm sorry, I had to.
Maybe third after Richard as well.
Yeah, exactly.
Well down the list.
Well, good morning, everybody. Thank you so much to the previous panel for really setting the tone. Huge congratulations to Basil and the BMG team on putting a superb event. I really have missed physical conversation and having the chance to really have one-to-one in-depth conversation. So Tom, really looking forward to our session. Charlie, I guess, really set the tone earlier in terms of the sort of importance of dual listing. I think what would be super helpful, Tom, is actually, assuming everybody understands what dual listing actually means, as well as perhaps a couple of tangible examples. But to really set the tone of our exciting conversation, I'd love to hear your definition of dual listings, and perhaps a couple of tangible examples would be super helpful. Thank you.
Thanks very much. Well, let's kick off with that. I think Charlie gave a couple of statistics earlier, which I just thought were worth just reiterating, that this is not a new phenomenon that we're seeing. The London market has always been very open to partnership, has always had the philosophy of open access, and therefore has actually encouraged actively dual listings over the years. And if you think back to the days of Jonathan's Coffee House, 200-300 years ago, when the London Stock Exchange was first formed, it was really about financing international trade, ultimately, and that whole international part of the DNA of the exchange remains as strong today. The technology is a little bit better than it was just sticking bits of paper up on the wall of a coffee house. But fundamentally, what London is here to do, to help finance international as well as domestic companies, and to make the linkages work as smoothly as we can across markets, is really, very much part of what we try to do. So we have about 280 companies across our entire market that are dual listed on another exchange. Most of those are at the larger end of the market, so on our main market. So of our 1,000 or so companies that list and trade on our main market, about 25% of them, about 250, have a listing or another trading venue elsewhere. So that's quite a big proportion. And those dual listings really are all around the world, from London-listed UK companies that have added a New York listing over the years, to companies from Australia, from Canada, from frontier markets who are looking to add liquidity in London, even to Western European markets where companies want to expand their investor base and visibility and profile into the London market. It's one way of doing that. It's a mechanism of putting yourself back on the top of in an investor's agenda. I think it's really interesting sort of seeing how I think the world's gone a little bit full circle on this, actually, because I started, I'm showing my age now, but I started in the capital markets as a young graduate about best part of 30 years ago. Let's call it 25. It sounds a bit better.
We'll go with 25.
and actually in those days, if you wanted, for example, as a UK company to tap into a US investor base at the time of IPO, you had to do a dual listing. You had to list in the market where you wanted to attract that investor.
So there was no other option at that point?
Well, investors just didn't, in those days, tend to invest cross-border nearly as much. Yeah. So they're quite parochial. They had their portfolios. They look at those day to day. And so if you wanted to make sure you gave yourself the maximum investor reach, you did a dual listing. And then I think you saw a period where that the necessity of that decline, because ultimately we've seen this whole trend of globalization that right across the board, from the way companies operate to the way investors operate with very international portfolios. So the number of dual listings and the necessity for those, or the desire for those, we saw drop off a little bit. I think in the last sort of 3, 4, 5 years, we've just seen that pick up a little bit again, because people, I think, realise that whilst investors may well have the capacity to invest anywhere in the world, they don't always have the time. They don't always have the, just putting yourself
as well,
exactly,
right?
and
having
having
access.
that ease and of trading, I think makes a real difference. So we've seen quite a number of those this year. I mean, give you a couple of examples, both of which were dual listed, one way round and one the other, if you like. So we had, even though the IPO market is quiet, the two biggest listings this year have been Haleon, which was the demerger out of GlaxoSmithKline, which listed a week ago, which, as well as having the anchor in the London market, premium listed, part of the FTSE 100, they also have a US listed ADR as the parent GlaxoSmithKline has. And the other largest listing year to date was Woodside Energy.
Yes.
The Australian energy business did a huge M&A deal to buy BHP's exploration and production assets, combine that into one entity, and we look to dual list, to expand the investor base further into the EMEA region. Also, of course, BHP historically had a very high concentration of UK investors, so they wanted to make sure that they gave those incoming investors into the new vehicle the best opportunities and access to trade it here. So we've seen a variety of different drivers for that. But I think in a world where, in some respects, everything, capital flows, freely, and investors think more globally than ever, still actually the rationale for why you would do it, to make sure that you're giving yourself the most chances of being investable in those markets, we're seeing that pick up quite a lot.
Thank you for that, Tom. I think what was also really interesting for me is sort of seeing how the London Stock Exchange has such a global portfolio. So I believe 38% of companies that are actually listed are international companies, which perhaps other markets, for example, don't necessarily have such a high percentage of that. And I think what's really relevant for the conversation today is, how, what are some of the benefits for that? And obviously you're encouraging international companies even more so to list on the London Stock Exchange. What are some of the sort of tangible benefits, before, of course, innately asking what some of the challenges have been, which I know is perhaps a harder conversation to talk about, but it would be super beneficial to understand perhaps some of the benefits and why you encourage companies to list here in the London Stock Exchange.
Yeah. No, of course. I think there's a number of things that people look at. I think if you think about, first of all, sort of what an exchange does, ultimately it's a place where buyer meets seller, if you like, and both sides of that are important. One, I think, is the international nature of the issuer base already. So a company looking at the London market can say, I can list alongside a peer group globally in this market that is covered by a set of analysts that understand the sector, and that there's that diversity and of international exposure. Here in the London market, the investors understand those international stories. So I think, partly it's around the issuer side of it, and for any international company thinking about London to say, look at the history, look at the welcome you're going to get, look at the fact you can be listed, benchmarked against, all of these names. So that's one side. Then I think you've got the other side, which is clearly the investor access point,
Yes.
which I think remains, very important. Now, whether technically the obstacles to buying overseas and buying cross-border exist, and we see in many markets those are coming down, sort of year on year on year. We still see practically a large number of, for example, investors who own LSE listed equity who don't yet have investments in Saudi. Now, that and every year the number of sort of qualified investors that have accounts set up in Saudi sort of ticks up. But there is still a great opportunity. So I'll give you an example. So, and by the way, this data may well already be sort of somewhat lagged because sometimes the databases take a while to catch up. But we looked at the 3,800 or so institutional investors that own LSE listed equity. And all but about 200 of those don't have a position yet in a Saudi equity that we can pay out. So it's about 200 out of. So it's a real opportunity to tap into. Now, I mean, Tadawul and the Saudi equity market has been, by the way, don't get me wrong, it's been one of the great success stories of the last decade in capital markets, and they've shown phenomenal depth of placing power, depth of daily trading liquidity, and ability to get really quite substantial transactions done. But I think to move it to the next stage, it's are there further opportunities to get some of the biggest global investors with that real firepower to either invest in Saudi for the first time or actually to invest more through instruments in which they are day to day, seeing in their time zone, in their sort of front and center of focus when they get in every day. And my argument would be absolutely yes. I think then if you look at in a market like Saudi, there's some very practical elements of just extending the trading day that we see, and this is particularly true for. I'll give you an even more extreme example, but why a lot of the Australian listed miners look at the London market. They want to head towards almost a 24-hour trading, for their stocks. So we look at there is a. I'm going to get this. I hope I get this right. I think it's a 3.5 hour.
Time difference.
No, in terms of the sort of overlap,
yes.
in when the markets are open, but quite long periods where the London market is open, but Tadawul's already closed.
Yes, exactly.
So, and if you track actually the day-to-day liquidity on the London market through those latter trading hours and the closing auction on the London market, where now 30-40% of the day's volume can go through just in the final auction. About 75% of London's daily trading volume happens at a point where Tadawul is closed. So this is a great opportunity to say you're extending your trading day, and then of course you're also going from effectively 5 to a 6-day trading week because you're opening that up on Fridays in the UK, and of course you've then got Sunday. In Saudi as well. So I think those are some of the practical reasons people look at, along with profile, visibility, currency for international acquisition. Some of those more tactical elements for thinking about executing it as well.
Well, I think we also perhaps prior to sort of the chat we had earlier was there are key, perhaps obvious benefits from greater liquidity to sort of, as you said, access to larger capital. But perhaps the other thing that I thought was quite interesting is one of the, not red flags, but perhaps one of the sort of reasons why companies perhaps sort of steer clear of dual listing is issues around governance and regulation. And although there is a positive to that, what are some of the ways that we can perhaps encourage companies to perhaps overcome some of these innate challenges that are going to happen through dual listing?
Yeah. No, it's a good point. I think that there is inevitably going to be some elements of incremental disclosure that companies are going to have to navigate by doing the dual listing. I think as things stand, one of we have a number of different listing segments on the London market, from AIM, our growth market, and that has some parallels, of course, with the sort of exciting times in the stage of NOMU that is really in its infancy. We know, having started a growth market, best part of 30 years ago, it takes quite a long time to really get to where we are. So, but I think that's been a phenomenal success. But for larger companies thinking about dual listings, we have the main market, we have the premium segment and the standard segment. The standard segment is where most of our international companies choose to list. And on that segment, there is no expectation that you adopt the UK Corporate Governance Code, for example, as a premium segment issuer would be expected to do, listing here. There are many GDRs, for example, which tends to be what the instrument that people list on the London market, where the sort of
Slightly more
incremental
flexibility.
rules and regs around them, and the flexibility, as you say, is much, much greater. So I think we can make that aspect as pretty smooth. I think one of the other things that companies are think intuitively, well, if I list on another market, am I going to split liquidity across exchanges and therefore ultimately cannibalize what I've got in my home market, and how's that going to play out? And I think that's often a concern, not just, by the way, for the companies, but also for regulators, for politicians, sort of thinking about whether this is a good thing for the country or a bad thing for the country. One of the things we've tracked over the last few years is what's happened to the daily trading liquidity in the local market in the 1 year following adding a London listing, because we quite often have companies which are already listed elsewhere come and add a London listing. And over the previous couple of years, this was a study done at the end of 2021. I think the data remains fairly consistent, but in addition to the liquidity that obviously is incremental in London because you didn't have it before, the liquidity on the home market is up an average of 60% in the 12 months after compared to the 12 months before. So I think the way we've always talked about this is it's a real win-win scenario, because ultimately, Tadawul would in this case, and Saudi, benefit from that incremental investor focus, and inevitably people start trading one thing and they say, oh great, so I need to learn more about Saudi, and what are the other things I should be trading in, and you'll start to then see that that sort of flow pick up, and we've seen it across many markets over the years. So I think it's a really exciting opportunity.
No, and I think it's a really great point there, Tom. And I think also, as you've mentioned, is sort of the importance of perhaps innovating and being a bit agile as a market to be able to then cater to companies. And as you said, there's not necessarily a requirement to perhaps go on UK regulation, and being able to be, to adapt to the situation, I think is what, again, perhaps put the London Stock Exchange in a different bracket to some of the other markets, which I find fascinating. And I think on that point that you just raised as well, and you touched on it a few times, and one of the discussion points that we wanted to explore was that growing relationship between the London Stock Exchange and Tadawul. And, we've seen huge growth in the last decade. What are some of the learnings that you've seen, and perhaps some of the projections, which I know that's a big question there, but it would be very beneficial, I think, to understand perhaps some of the learnings that we've seen with this relationship and how we see it growing perhaps in the next decade, post-Brexit, post-COVID. What do we see the benefits of this relationship?
Look, I think it's a relationship which we are building for the long term. It's one where I've been a fairly frequent visitor to the Kingdom now since 2015, 2016, and over that period we've had a very, very constructive dialogue with the CMA, with Tadawul themselves, and with many of the companies. I think Tadawul were very, very open about what they wanted the foreign listing regime to look like, what the GDR rules would need to look like. Obviously now they've been in place a couple of years now, at a period where, of course, market conditions weren't necessarily right to do it. So there hasn't yet been that the sort of consummated, if you like. But I think the political will to us appears to be there. There's been very much a collegiate approach to getting to us to be able to comment on certain aspects of the rules that would make it more easy and straightforward for companies to use. So I think that relationship has been there, and we look forward to that continuing. I think we see that as a sort of natural extension to what we've done, as Charlie referred to, in the fixed income space. Yes. We've seen a good flow of Saudi issuers come to the London market. Now, of course, in fixed income it's slightly different. Yeah. It much less trades on market. It's much more of an OTC market. The listing itself in the debt market is a little bit more around sort of profile and marketing, as opposed to necessarily where it trades. But I think that is hopefully the sort of natural extension to keep that keep that collaboration going and sort of really see that through. Again, I mentioned Nomu. I think
Which is
we were
exciting.
Yeah, really exciting. And we were very sort of flattered, and I'm sure we weren't the only exchange but around the world, but having had the AIM market run for now over 25 years, the Tadawul team spent a long time here trying to understand the model, how it works, what are the differences. Is it just the rule book that needs to be a bit more flexible for young companies, or how do you nurture the rest of the ecosystem to support it and bring the buy side with you? How do you encourage brokers to build research? And we were hopefully able to give them some good insights on that. I mean, some of it is around sort of blood, sweat, and tears and perseverance.
I'm sure.
But again, I think from a standing start to see where that market has developed is really, really encouraging. And yes, it's had its ups and downs, but that's the nature of growth equity, and it's risk capital ultimately.
It's expected almost.
It
so
is.
yes.
Yeah, it should be.
Yes, exactly. Before I carry on with my questions, I thought maybe we'll have an interlude and ask, and if the audience had a particular question that they wanted to ask. Basil, over to you.
Tom, I've been a member of your marketing team in Saudi Arabia trying to promote LSE as a dual listing exchange. I've talked to so many CEOs of leading companies in the main market, and there are two reasons for not dual listing: cost and disclosure. So, if you can tell us more about how we can overcome these two challenges. My second point will be about the Nemo market, which is the equivalent of AIM. And the Nemo market was created to allow family companies to have the first stepping stone to go public. So it's less costly, flexible, and faster. So can we match dual listing here with these kind of advantages for the Nemo market, so we can add it to the benefits when we talk to those families?
Yeah. Look, I think in terms of sort of cost and disclosure, I mean, I think I'd say a couple of things. Firstly, there's a number of aspects that go into that cost. I hope we, as the stock exchange fees, are we're only a small part of that problem. Ultimately there are fees to be paid to lawyers to help draft prospectuses, and banks ultimately to which we have little control over, but
and financial advisors.
And of course,
Don't forget that.
reputable financial advisors such as yourself, Basil, need to be properly compensated. All important. But I think where we can really make strides, and which is where I think some of the consultations that Charlie referred to are going, is making the listing regime easier to attain in the first place. And so trying to streamline some of the rules. And you've seen the FCA first changes to the rule book at the end of last year, looking at changes in free float, changes in dual class shares, and what you can do with those. So I think there's that broadening access point, moving into then a series of consultations this year around how companies raise further capital once they're on market. And you'll have seen in the review that was, maybe you'll have seen, but it was bits of big news here, the review conducted by Mark Austin at Freshfields, with a lot of input from the market, where talking about doing much more substantial placings on a non-preemptive basis without documentation. If you're conducting a rights issue and raising capital for the company without doing an acquisition, and where you're not actually fundamentally changing the direction of the business, why do you need a prospectus at all? So there's quite fundamental changes that are going to go on, both in terms of the listing rules, but also the prospectus regime here, I think, over the next sort of 12 months, which I think will continue, Basil, to your point, to chip away at the cost of being an ongoing sort of listed company on market, and make that access to incremental capital even more straightforward. On the disclosure point, I'm not sure there's a fix on that, because ultimately, companies are going to be, need to comply with those rules. I think as as some of the disclosure requirements harmonise over time across markets. And for example, you look at sort of TCFD climate reporting that's now coming in the UK, not just for premium listed businesses, but also for standard listed GDR. So if a Saudi company were to dual list, that'd be something they would need to take on board over a certain time period. I think as those things harmonise across markets, so hopefully the sort of cold water shock of adding another set of rules and regs, I think becomes smaller and smaller over time anyway. And sorry, to your final point on NOMU, very briefly, really excited about the possibility of that. And whilst we have a number of AIM companies that are dual listed, as well, I think there tends to be, for some companies, a size threshold where they say, unless I'm X $100 million of market cap, actually a dual listing probably doesn't make a huge amount of sense. I think in certain sectors and with certain company stories, actually even earlier stage businesses make it work well. We've had AIM and Euronext, dual listings. We've had AIM and ASX and TSX and some of these other markets. So absolutely no reason why we couldn't look to sort of streamline that process for normal companies looking at AIM as well for potential dual listings.
Especially that emphasis of family businesses, because of course they make sort of 60% of the economy from the kingdom, and it's that they play such a huge, significant role. And actually seeing their sort of the opportunity that they have now, it's remarkable, and it's seeing that growth. And if we can sort of have the hand holding and learning from the LSE, I think it would be hugely beneficial. Thank you for that question, Basil. Well, did anybody else have another question before I start? Yes, please. If you could introduce yourself.
My name is Asan. I'm an Islamic finance specialist. My question is regarding sukooks. I know London Stock Exchange has did quite a few sukooks in the past this decade. How do you see going forward? Is there any more demand, and is there any secondary market? Because that's where the challenge is for sukooks, and how you can overcome the secondary market. And how can you create that secondary market for sukooks? Yeah, thank you.
Well, look, first on the first point, yes, we see continued sukuk issuance, and we see a pipeline of further issuers looking to exploit, and indeed people taking certain aspects of the bond market and putting those together in different ways. So we've seen green sukuk, for example, for the first time, which is quite exciting. Market development. So I think on the issuer side, we see continued demand. I think on the investor side, again, for the right stories, the right credit, all the right sort of metrics, we see that continue too. So it's not a vast market for us, but we have 50 or so active sukuk at the moment on market. We've seen the British government sort of lead the way in terms of one of the first sort of non-Middle Eastern countries to issue sukuk in this market, and that I think was a real sort of shot in the arm for the market. And we see a number of international, companies, follow them. Virgin issues sukuk on the market here, so it's I think a market will continue to see further innovation. On the secondary market side, I think back to the point I made before about debt as a whole, as an asset class, being still quite substantially an over-the-counter, market. Now there are things that we can do to support that. We happen to own TradeWeb now, having completed our deal with Refinitiv. That has brought some fixed income trading, back into the market. We continue to sort of promote sort of use of that and build up in terms of sort of building up sort of pre-trade and post-trade sort of visibility and ultimately liquidity in the bond market. No reason why that wouldn't extend to sukuk as well. So that's something that we're very actively working on, because I think getting primary issuance done is one thing, but if investors then don't feel they've got the ability to freely trade in and out, that becomes a bit more of a problem.
Thank you.
Thank you so much. I'm actually quite sad to say that we've actually almost come to the end of our panel, and perhaps we did need the hour, because I think we were sort of saying that half an hour wasn't quite enough and an hour perhaps too long, but actually I felt that we could have perhaps gone even deeper. But Tom, thank you so much for sharing your insights this morning. I think it's a huge opportunity, and it's very reassuring to see the growing relationship between the LSE and Tadawul, and I look forward to perhaps this time next year hearing even more progress and growth and innovation within that space. So thank you so much. A round of applause, please, for Tom.
Thank you.
Thank you so much. Great session. Thank you.